Welcome to this presentation on the requirements of the revised AS 2501, Auditing Accounting Estimates, including Fair Value Measurements. I'm Dominika Taraskevich with the Office of the Chief Auditor, and I'm part of the project team that helped develop the revised standard. Presenting with me today is Sarah Madras, also with the Office of the Chief Auditor. Before we begin, I'd like to remind everyone that the views we express are our own personal views and not necessarily those of the PCAOB, members of the board, or the PCAOB staff. So with that, let's turn to our agenda. Our topics today will cover the key components of the rulemaking, including enhancements to the risk assessment process, the approaches to substantive testing of accounting estimates, and the new requirements for auditing the fair value of financial instruments. We will also touch on a few additional requirements within the standard and amendments made to other PCAOB standards. And finally, we will direct you to some resources that can be helpful as you implement the revised standard. But before we get into all that, Sarah, maybe you can give us a brief introduction into the revised standard.
Sure. The new requirements are presented as revised and retitled AS 2501, Auditing Accounting Estimates, including Fair Value Measurements and related amendments. The standard and amendments will be effective for audits of financial statements for fiscal years ending on or after December 15, 2020. Once effective, this standard will replace the three standards auditors use historically in this area, which are listed on the slide. The old AS 2501, which applies to auditing accounting estimates in general, AS 2502, which applies to auditing fair value measurements, and AS 2503, which applies to auditing derivative instruments, hedging activities, and investments in securities. These legacy standards have some overlap in scope with each other and contain similar approaches for testing, but describe those approaches in varying level of detail. So now there is a single standard that sets forth a uniform, risk-based approach for auditing accounting estimates, including fair value measurements. So what are the key aspects of the revised estimate standard? First, it applies to accounting estimates in significant accounts and disclosures. And at a high level, the standard focuses auditors on estimates with greater risk of material misstatement. And this was done through more explicit integration of the requirements of the standard with the board's risk assessment standards. It emphasizes application of professional skepticism, including addressing potential management bias. And this is important given the subjective nature of many accounting estimates. So throughout the standard and amendments, you will see several requirements that help prompt auditors to devote greater attention to addressing potential management bias in accounting estimates. Another key aspect is that it retains the three existing approaches to substantively testing estimates that are used today, but enhances the auditor's responsibilities under each approach to provide more clarity. Finally, the standard provides specific direction on auditing fair value of financial instruments, particularly when pricing information is obtained from third parties.
Great, thanks. Now that we have some background, let's get into the overall approach to auditing estimates under the revised standard, starting with risk assessment. AS 2110 establishes requirements regarding the process of identifying and assessing risks of material misstatement, and these fundamental auditor responsibilities remain the same. The revised estimate standard builds on those requirements and addresses how the auditor's responsibilities under the risk assessment standards apply to accounting estimates. To start, the estimate standard reminds auditors that the risk assessment process includes identifying accounting estimates in significant accounts and disclosures, understanding the process by which accounting estimates are developed, and identifying and assessing the risks of material misstatement related to accounting estimates, which includes, for example, determining whether the components of estimates in significant accounts and disclosures are subject to significantly differing risks. In addition to what's in the revised estimate standard, we also made some corresponding targeted amendments to the risk assessment standards. And let me give an example of this. The existing requirement in AS 2110 that provides risk factors for identifying significant accounts and disclosures has been amended to include risk factors specific to identifying significant accounts and disclosures involving accounting estimates. Those risk factors are listed on the slide and include the degree of uncertainty associated with future outcome of events and conditions underlying the significant assumptions, the complexity of the process for developing the estimate, the number and complexity of significant assumptions associated with the process, the degree of subjectivity associated with significant assumptions, and, if forecasts are important to the estimate, the length of the forecast period and degree of uncertainty regarding trends affecting the forecast. And these factors are important as they not only help identify significant accounts and disclosures involving estimates, but also can affect the auditor's determination of the likely sources of potential misstatement. Another area that was amended is the requirement for auditors to obtain an understanding of the company's information system. As part of this understanding, auditors are now explicitly required to understand the processes used to develop accounting estimates, including the methods used, which may include models, the data and assumption used, including the sources from which they are derived, and the extent to which the company uses third parties other than specialists. The amendment also references the auditor's responsibilities for understanding management's analysis of its critical accounting estimates, which we will talk about a little bit later. I'll also mention that to the extent a company uses the work of a company specialist, the auditor is also required to obtain an understanding of the work and reports of the specialist and the related company processes, and that requirement is part of the specialist rulemaking. So taking a step back, we recognize that auditors are already required to have an understanding of the company's process for developing estimates, but putting a bit more specificity around this understanding is intended to help auditors focus on what's driving the risk associated with the estimate. So for example, estimates based on multiple forward-looking assumptions will generally involve different risks than estimates that are developed largely using historical information. Amendments were also made to the requirements around the engagement team's brainstorming session. Under the risk assessment standards, key engagement team members are required to discuss the potential for material misstatement due to fraud. This requirement has been amended to include, as part of that discussion, how the financial statements could be manipulated through management bias in accounting estimates. So for example, thinking about potential management bias may include the risk of management override of controls related to accounting estimates. Before we go on, I do want to go back to something I mentioned at the start of this section. Identifying and assessing the risks related to accounting estimates include determining whether the components of estimates are subject to significantly differing risk and which accounting estimates are associated with significant risks. And the point about components of estimates is important and particularly relevant to certain accounting estimates. For instance, an estimate of a valuation allowance may have a general component and a specific component that give rise to different risks. A warranty reserve may have multiple components with differing risks based on differences in product lines. So those are just a couple of examples. In addition, the requirements for identifying and responding to significant risks related to accounting estimates have not changed. The risk assessment standards already provide factors that auditors should evaluate in determining which risks are significant risks, and those factors continue to apply when evaluating risks associated with accounting estimates. So with that, I'll turn it back over to Sarah.
So now that we covered identifying and assessing the risk, I wanted to touch on the high-level requirements related to responding to risks. Under the revised estimate standard, responding to risk involves evaluating whether the accounting estimates are in conformity with the applicable financial reporting framework and reasonable in the circumstances. It also involves evaluating potential management bias in accounting estimates and its effect on the financial statements. And again, this is aligned with the basic requirements in AS 2301, the board standard on responding to risks of material misstatement. The estimate standard also requires the auditor's response to include procedures responsive to differing risks in components of accounting estimates. So in the warranty reserve example Dominica just gave, the risks associated with claims history of different product lines may drive the need for a different audit response.
This may be a good time for a reminder that the risk assessment process continues throughout the audit. As circumstances change, new risks may emerge, or the assessment of previously identified risks may need to be revisited. So the auditor may need to revise the risk assessment and modify planned procedures or perform additional procedures to respond to the revised risks.
The estimate standard also includes a reminder that the auditor's responses to the assessed risks of material misstatement, particularly fraud risks, should involve the application of professional skepticism in gathering and evaluating audit evidence. And as you know, audit evidence consists of both information that corroborates and contradicts management's assertions.
We often get asked about whether the revised standard is scalable. Sarah, maybe you can speak to that a little bit.
Sure. So the revised standard is designed to be scalable. And what I mean is, the amount and nature of the evidence you need really depends on your risk of material misstatement. So as we get into the substantive procedures in the next section, you'll see that the standard does not prescribe the extent of procedures to be performed beyond the requirement to respond to risk and the direction provided for applying the testing approaches. And it is important to point out that scaling the procedures doesn't necessarily always mean scaling them down. If you have a risk where the magnitude and likelihood of misstatement is assessed as higher, the nature, extent, or timing of procedures may be modified to respond to the risk in order to obtain sufficient persuasive audit evidence. It is the risk and its assessment that drives the response. And let me give you an example here. In a business combination, testing the valuation of assets acquired that have a readily determinable value will generally require less audit effort than testing the valuation of identifiable intangible assets that are based on more subjective assumptions. So with that, let's dive into substantive testing. The three approaches to substantively test an estimate are: test the company's process, develop an independent expectation, evaluate audit evidence from events or transactions occurring after the measurement date. And auditors can continue to use one or a combination of these approaches. As we mentioned in the last slide, the three substantive approaches in the extant standards have not changed. However, the audit procedures under each approach have been clarified. As we get into the details of the procedures under each approach, you'll see they include more specificity, similar to the standard for auditing fair value measurements AS 2502, which is being replaced. You will also note that certain key requirements from that standard have been retained, but extended to apply more broadly to other accounting estimates in significant accounts and disclosures. Dominica, what are some things auditors would think about when selecting a substantive approach or approaches?
Well, there is no one-size-fits-all approach. How you determine which approaches to use will be informed by several things: your understanding of the process the company used to develop the estimate, and, if relevant controls are tested, the results of those tests. So let me go through a couple of examples here. Testing the company's process may be appropriate if the auditor intends to rely on controls over the process, or the company uses complex proprietary models to develop an estimate. If the company's controls over an estimate are ineffective, then developing an independent expectation of the estimate may be appropriate. If an estimate has multiple components or multiple significant assumptions, the auditor may want to use different approaches for the individual components or for individual significant assumptions, like in the valuation example that I gave earlier. Of course, if there are relevant subsequent events or transactions that occur, evaluating those events and transactions may be your best testing approach. So let's talk about the three approaches in a bit more detail, starting with testing the company's process. So this slide summarizes the auditor's responsibilities under the revised standard for testing the individual elements of the company's process, meaning the method, data, and significant assumptions used. And we'll break down the requirements for each. So how do you evaluate the company's methods? The methods a company uses to develop an accounting estimate and the corresponding inputs will typically depend on the nature of the estimate. So for some estimates, like certain fair value measurements, the method may involve the use of a model or another valuation method, like one for instance based on expected future cash flows. But for other types of estimates, such as obsolescence reserves, the method might be a calculation that's based on historical trends or other relevant data. The auditor is required to evaluate whether the method is in conformity with the requirements of the applicable financial reporting framework, and this would include whether the data is appropriately used and the significant assumptions are appropriately applied, and whether the method is appropriate for the nature of the related account or disclosure, taking into account the auditor's understanding of the company and its environment. In some cases, financial reporting frameworks may prescribe a specific method to develop an estimate. In other cases, the frameworks may allow for alternative methods or may provide guidance on how to apply a method, including the selection or use of assumptions or data. It's important to keep in mind that the nature and extent of audit procedures to evaluate the method used by the company depend on the risks of material misstatement associated with the estimate. And this may vary with the type of estimate or with the process used to develop the estimate. So along those lines, Sarah, what are some things that auditors might think about if the method involves a model?
There are several things auditors may want to focus on. And remember, we are just talking about evaluating the method here. So let's say you have a method that uses a commercially available valuation model. The risks associated with that model may relate to whether the model is appropriate for the related estimate under the applicable financial reporting framework. If the method uses an internally developed company model, you may have additional risks associated with how the model was developed, including the potential for management bias that would likely result in additional audit procedures. In either case, you may have other potential risks of material misstatement relating to the mathematical accuracy of the calculations used in the model, and if the output of the model is adjusted or requires adjustment, the appropriateness of the adjustments. So something to keep in mind. For certain estimates that involve complex models or processes, it may be challenging to obtain sufficient appropriate audit evidence without testing the controls over the development, operation, and/or maintenance of the models. So in addition to substantive testing, it may be necessary to identify and test relevant controls, including ITGCs. These are some of the things you may want to think about.
Thanks. So one last thing related to methods. If there has been a change in the company's methods, the auditor should determine the reasons for the change and evaluate the appropriateness of the change. when the company has determined that different methods result in significantly different estimates, the auditor should obtain an understanding of the reasons for the method selected and evaluate the appropriateness of that selection.
Okay, so let's turn our attention to data. The nature and extent of procedures to be performed with respect to data depends on whether the data is produced by the company or from external sources. Generally speaking, the requirements in this area align with existing requirements in AS 1105, the evidence standard. For data produced by the company, auditors are required to test the accuracy and completeness of the information or controls over the accuracy and completeness, and evaluate whether it's sufficiently precise for purposes of the audit. For example, a company produced report of historical data on warranty claims. A point I want to make here is that if the company provides data to a third party like a specialist, that is still company data. For data from external sources, the auditor should evaluate the relevance and reliability of the data. Let's say you are considering forecasted information in an expected credit loss estimate. If an auditor is auditing projected losses for a loan pool that includes loans concentrated in a certain geographic area, industry default rates may be a significant assumption in the company's estimate. Industry data that is not representative of the specific geographic location of the loans would be less relevant than industry data that is specific to the geographic locations of the loans. For both internal and external data, the auditor is required to evaluate whether the data is appropriately used by the company in developing the estimate by evaluating whether the data is relevant to the measurement objective for the accounting estimate, the data is internally consistent with its use by the company in other significant accounts and disclosures, and whether the source of the company's data has changed from the prior year, and if so, whether the change is appropriate. So let's say the company changed the source of data related for an estimate. While a new source of data may lead to an estimate that better reflects the company's circumstances, a change in data source could also be used by a company to achieve a desired financial result. So that is something to think about, and here is another area where we emphasize the application of professional skepticism.
Okay, so we've talked about methods and data, and now I want to focus a bit on one of the main parts of developing an estimate, the assumptions used. So for significant assumptions, there are two aspects of the requirements. First, the auditor is required to identify the significant assumptions used by the company, and you do that by taking into account the nature of the estimate, including related risk factors, the requirements of the applicable financial reporting framework, and the auditor's understanding of the company's process for developing the estimate. So said another way, auditors are using the knowledge that they've gained from the risk assessment process and other procedures to help identify significant assumptions. So what are significant assumptions? Well, they are the assumptions that are important to the recognition or measurement of the accounting estimate in the financial statements. And the standard provides examples of assumptions that ordinarily would be considered significant assumptions, including those that are sensitive to variation, such that a minor change in the assumption can cause a significant change to the estimate, are susceptible to manipulation or bias, involve unobservable data or company adjustments of observable data, or depend on the company's intent and ability to carry out a specific course of action. And I want to point out that the examples in the standard are not intended to be an exhaustive list of all the attributes of significant assumptions. Facts and circumstances will come into play here. In addition, the requirements for documenting the significant assumptions identified by the auditor have not changed. AS 1215 sets forth requirements for audit documentation, including a requirement that it contains sufficient information to enable an experienced auditor to understand the nature, timing, extent, and results of procedures performed, evidence obtained, and conclusions reached. So consistent with that standard, Auditors should document the significant assumptions they have identified and the rationale for that determination. Auditors are not, however, expected to document a detailed comparison of each assumption used in the estimate to the examples of significant assumptions that I just described.
Once the significant assumptions are identified, you are then required to evaluate them for reasonableness, both individually and in combination. The auditor should evaluate whether the company has a reasonable basis for the significant assumption. Recognizing what constitutes a reasonable basis will vary depending on the assumption. For example, a reasonable basis for implied volatility would differ from the basis for a historical volatility. Some assumptions might be supported by detailed calculations or historical information specific to the company, while other assumptions might be based on industry data. Here, the auditor thinks about whether the assumption is based on an analysis of relevant information or determined arbitrarily with little or no analysis. Did the company consider available relevant evidence regardless of whether it corroborated or contradicts the company's assumption? The auditor should also evaluate if significant assumptions are consistent with the following when applicable: relevant industry, regulatory, and other external factors, including economic conditions, the company's objectives, strategies, and related business risks, existing market information, historical or recent experience taking into account changes in conditions affecting the company, and other significant assumptions used by the company in other estimates. For example, assumptions used in multiple estimates, such as the growth rate for a specific product line, should ordinarily be consistent with each other. It is important to keep in mind that in some cases, assumptions that are based on past experience and management's expectations may not be reflected of current market information or be representative of expected future conditions or events. For example, changes affecting a company's industry may affect certain assumptions, such as those related to revenue projections or cash flow estimates. Something to point out is that the standard allows for auditors to evaluate the reasonableness of a significant assumption by developing an expectation of that significant assumption. In these circumstances, the auditor should have a reasonable basis for that expectation, and we will talk about that in the next section. For critical accounting estimates, the standard also requires auditors to obtain an understanding of management's analysis of its critical accounting estimates and take that understanding into account when evaluating the reasonableness of the significant assumptions and potential management bias. And we touched on this when we talked about understanding the company's process for developing accounting estimates. By way of background, the term critical accounting estimates originates from the SEC's rules and regulations. A critical accounting estimate is an accounting estimate where the nature of the estimate is material due to the levels of subjectivity and judgment necessary to account for the highly uncertain matters or susceptibility of such matters to change, and the impact of the estimate on financial condition or operating performance is material. The SEC's rules and regulations set forth management's responsibilities for making disclosures relating to the critical accounting estimates in the MD&A section of the 10-K. The critical accounting estimates subsection outlines the key assumptions used by the company's accountants and subject matter experts when developing estimates that may have a material impact on the company's financial statements. Under the revised estimate standard, the auditor is not expected to evaluate the company's compliance with the SEC's MD&A requirements, but rather to obtain an understanding of management's analysis of critical accounting estimates and to use this understanding in evaluating the reasonableness of the significant assumptions and potential for management bias in accordance with AS 2810. The sensitivity analysis used by the company in developing the critical accounting estimates disclosures for the year under audit can provide important information about the significant assumptions underlying those estimates. In addition, Auditors have a responsibility to make certain communications to the Audit Committee about critical accounting estimates. The requirements in our standard AS 1301 are aligned with and incorporate the SEC's requirements regarding Audit Committee communications. Auditors are required to describe the process management used to develop critical accounting estimates, management's significant assumptions used in critical accounting estimates that have a high degree of subjectivity, and any significant changes management made to the process to develop critical accounting estimates or significant assumptions, a description of management's reasons for the changes, and the effects of the changes on the financial statements. Auditors are also required to communicate their conclusions regarding critical accounting estimates, such as the basis for the auditor's conclusions regarding the reasonableness of the critical accounting estimates. So the requirements of AS 2501 are also intended to provide the basis for these required Audit Committee communications.
So in some cases, a significant assumption may be based on the company's intent and ability to carry out a particular course of action. The standard sets forth specific factors the auditor should take into account under these circumstances, and they are listed on the slide. I'm not going to spend too much time on these as they are similar to the existing requirements of the fair value standard that's being replaced, but I do want to emphasize that these factors continue to be important in evaluating the reasonableness of significant assumptions. So we've talked a little bit about testing the company's process, but auditors may also choose to develop an independent expectation of an estimate. Under the revised standard, the applicable requirements depend on the sources of methods, data, and assumptions used by the auditor to develop the expectation. So when the auditor derives assumptions or uses his or her own method in developing an independent expectation, the auditor should have a reasonable basis for the assumptions and methods used. And here you'd consider the nature of the estimate, the requirements of the applicable reporting framework, and other relevant factors. If the auditor uses data or assumptions obtained from a third party to develop the expectation, the auditor should evaluate the relevance and reliability of the data and assumptions in accordance with AS 1105. Finally, if the auditor uses either data produced by the company, significant assumptions used by the company, or the company's methods in developing the expectation, then the auditor should test the data, methods, and significant assumptions in the same manner as when testing the company's process. So here we've thought about the different ways that an auditor develops an independent expectation in practice. For example, with data, the auditor may be less likely to use his or her own data. Rather, the auditor would be more likely to use data produced by the company or, in some cases, external data. Auditors may also choose to develop an independent expectation as a range. In those cases, the auditor is required to determine that the range encompasses only reasonable outcomes in conformity with the applicable financial reporting framework and is supported by sufficient appropriate evidence. The sufficiency and appropriateness of the evidence needed will depend on the relevant circumstances, including the nature of the accounting estimate, the requirements of the applicable financial reporting framework, and the number and nature of significant assumptions and data used in the independent expectation. Again, the auditor needs to have a reasonable basis for the data, methods, and assumptions used. And we know that in some cases, the evidence obtained by the auditor may support a range that's fairly large. The requirement does not restrict the size of the range as long as it meets the criteria that we just talked about. For some estimates, events or transactions occurring after the measurement date can provide sufficient appropriate audit evidence. So similar to the existing requirements for subsequent events, the revised standard focuses auditors on whether the evidence related to the subsequent event or transaction is relevant and reliable to the estimate. So here you want to think about whether there have been any changes in the company's circumstances between the event date and the measurement date. As the length of time from the measurement date increases, the likelihood that events and conditions during that period have changed also increases. So that covers the requirements related to applying the 3 approaches to testing.
So now we move on to Appendix A of the revised standard. This section of the standard is a special topics appendix addressing certain matters relevant to auditing the fair value of financial instruments, such as when pricing information is obtained from third parties like pricing services. So what is included in Appendix A? The appendix establishes requirements to determine whether pricing information obtained from third parties, such as pricing services and brokers or dealers, provides sufficient appropriate evidence. The audit approach consists of identifying and assessing risks of material misstatement associated with the valuation of financial instruments and performing procedures to determine whether the pricing information provides sufficient appropriate evidence to respond to those risks. So let's look at this area in more detail. As part of the risk assessment procedures related to auditing fair value of financial instruments, the auditor should obtain an understanding of the nature of the financial instruments being valued. Matters that the auditor should take into account include the terms and characteristics of the financial instruments, for example, information about seniority, put-in call features, guarantees, and limitations on the holder's ability to sell, the extent to which the fair value of the type of financial instruments is based on inputs that are observable directly or indirectly, and other factors affecting the valuation of the financial instruments, such as credit or counterparty risk, market risk, and liquidity risk. The values of some financial instruments may reflect adjustments for external factors and other risks. For example, the risk of material misstatement of the valuation of debt securities issued by a company with good credit standing may differ from the risk of material misstatement associated with an asset-backed security collateralized by cash flows of lower quality loans. Generally speaking, fair values of financial instruments based on trades of identical financial instruments in an active market have a lower risk of material misstatement than fair values derived from observable trades of similar financial instruments or unobservable inputs. Something I want to point out is that based on the characteristics we just talked about and the knowledge that the auditor obtained throughout the planning phase of the audit, the auditor may group the portfolio of financial instruments into types of instruments that are similar and obtain an understanding of the nature of the instruments by type. It is important to note that in some circumstances, it may not be appropriate to group financial instruments. For example, where financial instruments are dissimilar, or where the auditor does not have a reasonable basis upon which to stratify the portfolio into groups.
Okay, so once the auditor identifies and assesses the risks of material misstatement associated with valuation of financial instruments, he or she should design audit procedures to respond to those risks. The auditor performs procedures to determine whether the pricing information used in the valuation provides sufficient appropriate evidence. And this includes assessing the reliability and relevance of the pricing information in accordance with the evidence standard. And the procedures here are consistent with the substantive approaches for testing estimates that we discussed earlier. For example, the auditor might use pricing information from a third party to develop an independent expectation, or may choose to evaluate pricing information provided by a third party that's used by the company. So whether auditors obtain the pricing information directly or evaluate pricing information used by the company, the procedures in this appendix apply. And this recognizes that based on our understanding of practice, there is diversity in how audit firms use information obtained from third-party sources in auditing fair value. But before we get into the specifics of the requirements, let's talk a little bit about the sources of pricing information. First, we have pricing services. So for the purposes of the standard, A pricing service is an organization that routinely provides uniform pricing information to users, generally on a subscription basis. Pricing services generally value financial instruments daily using market data and prices from market makers and a number of other sources. For some instruments, they may use a valuation technique or combine approaches to arrive at a price. One thing I want to point out here is that service providers that repackage and distribute pricing information obtained from other sources are not themselves pricing services. In addition, when a pricing service is engaged by a company or an auditor to develop a price for a specific financial instrument that it does not routinely price for its subscribers, the pricing service is acting in the capacity of a specialist. So, if the auditor concludes that the pricing service is functioning as a specialist, he or she would look to the applicable requirements for using the work of either a company specialist or an auditor specialist. Another often used source of pricing information are brokers and dealers. And finally, there are other sources of pricing information, such as websites maintained by exchanges. And here it's important to think about whether the website obtains prices directly from an original source, such as a stock exchange. I'll also note here that quoted prices obtained from a stock exchange for exchange-traded securities in an active market generally provide sufficient appropriate audit evidence.
The revised standard requires different audit procedures for the different types of third-party pricing information used for fair value measurements of financial instruments. It is intended to drive a level of work effort commensurate with the risks of material misstatement in the valuation of financial instruments. As we mentioned earlier, AS 1105, the evidence standard, requires auditors to evaluate the relevance and reliability of audit evidence. The appendix establishes factors that affect the relevance and reliability of pricing information obtained from third parties. These factors vary depending on the source of the pricing information, and we will go through this in a bit more detail. For information provided by pricing services, the factors that affect reliability include the experience and expertise of the pricing service relative to the types of financial instruments being valued. And here, relevant considerations may include, for example, the number and financial industry experience levels of evaluators employed by the pricing service, and the pricing service's evaluation quality controls and price challenge processes. Whether the methodology used by the pricing service in determining fair value of the types of financial instruments being valued is in conformity with the applicable financial reporting framework.
One thing I want to point out here is that many pricing services provide information to their subscribers about their methodology, and this can be assessed by the auditor in making the determination as to whether that methodology is in conformity with applicable financial reporting framework.
Thanks. And the last factor is whether the pricing service has a relationship with the company by which the company's management has the ability to directly or indirectly control or significantly influence the pricing service. And here the auditor should take into account the results of the procedures performed under AS 2410 related parties in determining whether the pricing service has a relationship with the company. Just a point to be made here. We recognize that practice in this area varies among firms. For some firms, the engagement teams obtain the prices and methods directly, while at other firms, this may be done through a national pricing desk. And for other audit engagements, it can be the company obtains the pricing information and the auditors audit this information. The auditor is required to evaluate the reliability, but the standard does not prescribe how the auditor does so, since we acknowledge there are differences in practice.
In assessing the relevance of pricing information from pricing services, you want to think about how the value is determined for the financial instruments being valued. For example, the fair value may be based on quoted prices in active markets for identical financial instruments, and these would generally be your level 1 instruments. For other financial instruments, the fair values may be based on transactions of similar financial instruments, generally your level 2s with readily available and recent market activity. And when no recent transactions have occurred for either the financial instrument being valued or similar financial instruments, or the price was developed using a quote from a broker or dealer, you want to think about how the fair value was developed, including whether the inputs used represent the assumptions that a market participant would use when pricing the financial instrument. And these would be your level 2s with little recent market activity or your level 3 instruments. So the revised standard requires the auditor to perform additional procedures depending on which of these buckets the financial instruments fall into. And auditors may already be performing some of these procedures in connection with auditing the financial statement disclosures.
So when the fair values are based on transactions of similar financial instruments, the additional procedures include evaluating the process used by the pricing service, including evaluating how transactions are identified, considered comparable, and used to value the types of financial instruments selected for testing. And the audit procedures necessary will vary in nature and extent based on factors such as the relevant risks and the process used by the pricing service. For example, matrix pricing, algorithm, or cash flow projections. Again, the standard requires auditors to perform procedures, but doesn't prescribe how to execute those procedures, recognizing there are different ways to approach this.
When no recent transactions have occurred for either the financial instrument being valued or similar financial instruments, the additional audit procedures include evaluating the appropriateness of the valuation method and the reasonableness of the observable and unobservable inputs used by pricing services. So you're really getting behind the numbers here, and these types of financial instruments would generally be valued individually. So what happens if an auditor is unable to obtain information from a pricing service about the method or inputs used? In those cases, the auditor will need to perform additional procedures to obtain sufficient appropriate audit evidence. And what you do here will vary depending on the circumstances. For example, auditors may think about obtaining and evaluating pricing information from a different pricing source, or obtain evidence about the inputs used from public data about similar trades, for example, data from trace or similar sources. You could also develop an independent expectation, for example, through the use of an auditor specialist.
A question we are often asked is whether auditors can perform audit procedures for financial instruments as a group rather than for each instrument individually.
Audit procedures can be performed for financial instruments as a group if the following conditions are met. The financial instruments are similar in nature, taking into account the terms and characteristics, the extent to which fair value is based on observable inputs, and other factors affecting valuation, and if the pricing service uses the same process to price the group of financial instruments. So if these conditions are met, then the financial instruments can be grouped for purposes of testing.
And that brings us to multiple pricing services. For some financial instruments, pricing information may be available from more than one pricing service. The appendix provides direction on the auditor's responsibilities when pricing information is obtained from multiple pricing services. Specifically, the appendix provides that when certain conditions are met, less information is needed about the particular methods and inputs used by the individual pricing services when pricing information is obtained from multiple pricing services. And those conditions are: there are recent trades of the financial instrument or a financial instrument substantially similar to the financial instruments being valued. The type of financial instrument being valued is routinely priced by several pricing services. Prices obtained are reasonably consistent across pricing services, taking into account the nature and characteristics of the financial instruments being valued and market conditions. And the pricing information for the type of financial instrument is generally based on inputs that are observable. Our understanding is that the approach of using pricing information for multiple pricing services is not a prevalent practice. Some firms, however, may follow a methodology where rather than obtaining a price from one pricing service, they have chosen to obtain pricing information from multiple pricing services on a centralized basis for the purpose of looking at the convergence of prices across multiple pricing sources. And they would then provide that information to their audit teams to use as audit evidence for the fair value of financial instruments.
Yeah, so generally speaking, the conditions relate to situations where you have reasonably consistent pricing information that is available from several sources with ample observable inputs. And by several, I mean more than two. So for example, some easier to value level 2 instruments priced based on transactions of similar instruments might meet these conditions.
So if you meet the conditions we just discussed, you may not need to perform some of the additional procedures we described earlier with respect to methods and inputs of the pricing service.
We also want to note that this requirement does not apply if the firm or engagement team is subscribing to and using information from multiple pricing services for different reasons other than this planned audit approach, for example, to inform risk assessment.
The appendix also provides factors that affect relevance and reliability of broker quotes. Relevance and reliability depend on the factors listed on the slide. So the way to think about this is that broker quotes generally provide more relevant and reliable evidence when they are timely, binding quotes, without any restrictions, limitations, or disclaimers, from unaffiliated market makers transacting in the same type of financial instrument. We want to point out that a relationship with a broker or dealer is not intended to mean a customer relationship. Rather, think of a relationship as, for example, when the broker quote is made by a broker who is a holding company of the issuer. If the broker quote does not provide sufficient appropriate evidence, the auditor should perform procedures to obtain relevant and reliable pricing information from another pricing source.
Okay, so this brings us to a few other requirements and amendments that we want to cover. With respect to evaluating audit results, the revised standard essentially reiterates the requirements of AS 2810, evaluating audit results. The auditor evaluates both the quantitative aspects and the qualitative aspects of the company's practices and evaluates potential bias in accounting estimates. The revised standard provides that evaluating potential bias in accounting estimates includes evaluating bias in estimates individually and in the aggregate. It also includes evaluating whether bias results from the cumulative effect of changes in estimates. A few other areas I want to touch on. You may recall that AS 2503, the standard on auditing derivatives, included requirements for valuations of financial instruments based on investee results. For example, investments accounted for using the equity method. These requirements have been relocated as an appendix to AS 1105 and remain largely unchanged. I also wanted to highlight that the existing requirement to perform a retrospective review for accounting estimates in AS 2401 was amended to further clarify that accounting estimates selected for testing should be those for which there is an assessed fraud risk. This requirement is better aligned with the revised standard and focuses the auditor on accounting estimates already identified through the risk assessment process as being susceptible to material misstatement due to fraud. We know that for some estimates, the outcome of the estimate may not be known within a reporting period to perform this review. In addition, a review over a multi-year period would not be feasible for some estimates. So we clarified that a retrospective review of accounting estimates in significant accounts and disclosures should be performed by comparing the prior year's estimate to actual results, if any, to determine whether management's judgments and assumptions relating to the estimates indicate a possible bias. So that sums up the requirements of the revised standard and amendments. But before we wrap up today, I wanted to highlight a few resources on our website that may be helpful. First, I encourage everyone to visit the Estimates Implementation page, where you can not only find the adopting release, but also two pieces of guidance designed to raise awareness of the new requirements. So the first covers the main components of the standard and the three approaches, and the second is specific to auditing fair value of financial instruments when pricing information is provided by third parties. And we will continue to update this page if additional resources are developed. Also, we wanted to provide you with a few additional links that you may find helpful. On this slide, we have information on where to find general standard setting activities and guidance, how to sign up for PCAOB updates, and where to submit inquiries on our standards. So this concludes our presentation today. Thank you for your attention and have a good day.